Lyft shares are dropping and dropping severely, down more than 13%. Company missed on revenue. Joining me now, Eric Jackson, EMJ Capital founder and president. Had you on. It's good to see you to talk about technology. You used to own this name. I suppose you're happy you don't today.
Yeah, definitely. I still own Uber, and actually, these results, make me incrementally more bullish on Uber. But I think the biggest concern for Lyft investors out of the whole report was the fact that they missed active riders estimates by almost 1 million. That says to me that they're losing market share to Uber, especially. And if you compare Uber's results of last week, a second quarter in a row of strong free cash flow, growing their business, growing active riders, they're taking share from Lyft. So Lyft is a pure play, obviously ride sharing only. So I just like Uber. It's still growing out of the pandemic, above kind of pre-pandemic levels. Has a more diversified, more global business than Lyft.
So you wouldn't buy Lyft again, based on what I hear you telling me now?
I think
all those things were true before, right? When you made the decision to buy Lyft over Uber, Uber had always had a more diversified revenue stream. They were always more global than Lyft is domestic, et cetera, right?
Yeah, the reason why I owned it is that if ride sharing was going to make a comeback, Lyft should outperform Uber because it is a smaller business. It's more volatile on the way up, as well as on the way down. And so it should have bounced back. But there are just many more risks attached to that business. And they've yet to prove, management has, that they can really kind of navigate out of this problem. So there's nothing in this report that would make me say, hey, I want to jump in to own these shares today. It's more concerning than it is comforting.
You want to jump in, speaking of using those words, to some of these tech stocks that have gotten hit, because tech has not done well lately. And I'm wondering how broken you think that space is.
Well, it's definitely broken. It's definitely been a terrible year for tech overall, Scott. When I was with you a couple of weeks ago, going into the big week of tech earnings, the only one of the big fangs that I really like was Apple. And that's still, it's really the last man standing from the whole FANG complex coming out of that. It is a name that I still like into the year end. Even on a day like today, when from the headlines last night, that they were slowing iPhone volumes to finishing the day positive by almost 0.5%. It continues to be the bellwether for tech.
Are we close to a bottom in some of these spaces? I'm looking month to date, right? The XLK itself is down 5.5%, but software, the IGV is down 9.5%. Cloud is down 16%. Some of those SaaS stocks have gotten absolutely annihilated. I'm thinking of things like Twilio lately, which someone on Halftime today told me that they bailed on, and they used to love the stock. Are we near a bottom or not?
It's really tough to say. I mean, you were asking on the last panel, can we get a rally into year end, and is tech going to sit that out, or is it going to participate? I mean, if there's truly a rally broadly in the markets, sooner or later, tech is going to participate, and all these names, the oversold names, and whether it's big tech or growth tech, are going to participate. But the last few weeks feel different from June of earlier this year, where we sort of went down quickly, hit a bottom. Tech had this big bounce back into early August. We've been oversold now for weeks in tech, and we're sort of searching for that catalyst to drive things up. Maybe it's going to be the midterms, and we'll see. Some might argue that, there's going to be tax loss selling ahead in many of these tech names into the year end as well. So we're due for a rally, but, it's anybody's guess if it is going to happen. So you have to be very selective and take things on a name by name basis.